More businesses are drop shipping. What tax considerations do I have when my business is not holding the inventory?
When we're talking about a drop shipment transaction, which is where there are, instead of two parties in the transaction, the seller and the buyer, there's a third party who is the shipper. And that shipper is often the manufacturer, and the distributor is the seller to the customer. And where drop shipments become challenging is when the manufacturer is registered to collect tax in the state where they are asked to ship the goods, so the customer's location. But the distributor may not. Although the transaction between the manufacturer and the distributor should qualify for what we call the resale exemption, because the distributor is going to resell it, there should be no sales tax on that transaction. In order to substantiate that, the manufacturer must receive what's called an exemption certificate from their customer, the distributor. And that exemption certificate has to meet the requirements for the state where the goods are being shipped. And if the distributor is not located in the same state where their customer and is not registered, they may not be able to issue the appropriate exemption documentation. Now, the good thing is most of the states do accept what is referred to as alternate documentation. So the distributor should be able to show to the manufacturer that it qualifies for the resale exemption. But in other states, such as California, if the distributor is not registered in California, but the manufacturer is, and the goods are being shipped to California, the manufacturer must collect sales tax from the distributor on not just their selling price, but their selling price plus an assumed 10% markup. And that tax cannot be passed on directly to the purchaser, and so the distributor must bury that tax cost in their cost of goods sold, obviously potentially impacting their margin.